Hello and welcome everyone. I'm Robert Baharian and this is Masters in Investing. On this show, I talk to guests about financial markets, the economy, investing and business. Don't forget to subscribe and leave us an awesome review. Let's get into it. My guest today is Richard Quin of Bentham Asset Management, one of Australia's most respected money managers. During our conversation today, we talk about inflation and what this means for the economy, for interest rates, and what it also means for investors. We talk about the China Evergrande Group and what it means for markets around the world, what it means for investors, and why it's just not another Lehman Brothers scenario. And finally, we talk about the domestic market. In Australia, we talk about interest rates, housing, and what Australian investors need to be thinking about today. Here's what I've got now. Hope you enjoy the conversation. Richard Quin, welcome back to Masters in Investing. It's good to see you again.
Thanks. Really good to talk to you.
Hey, Richard, we just did our, every quarter we release what we call the Financial Markets Handbook. It's like, I've got it in front of me now, it's like 90 pages long, and it's sort of a similar take on the JP Morgan Handbook, which I absolutely love. And so we kind of redevelop a lot of our charts out of that. And so if we're looking quarter end 30 September, so end of Q3, it's probably been, relatively speaking, and I will use the word disastrous periods relative to the last 12 months or so. But you've got S&P 500 flat, gold down, MISCI all country equities down, the German 10-year bond down, copper down, UK gilts down. There's probably a handful of asset classes that were up over the course of the last quarter. Commodities up about 6%, oil up 3%, Aussie residential property, the Nikkei and the ASX 200, only a handful of asset classes that were up over the last quarter. Can we maybe just get your take on sort of events that have unfolded over the course of the last few months and what's currently going on in markets at the moment?
Sure. So the last quarter or the last year?
Probably last quarter I'll kick off with, because there's a whole bunch of other things I want to get into, the Evergrande issue as well.
Yeah, sure.
Maybe let's just kick off with the last quarter.
Okay. So the last quarter, basically, you saw people start to get a bit more concerned about inflation globally. And so this the idea of stagflation has come through. And a lot of the reasons behind that are they're multifaceted inflation concerns. And again, being in Australia, it's a little bit hard to know the full context of it because we've been in shutdown. But globally, there's a lot of supply chain problems, which I think we've talked about before.
Yeah.
Chip problems and the like. You're looking at freight costs. Freight costs are going ballistic. You're looking at transport costs. Like there's a shortage of truck drivers, believe it or not. But you've got that, and then you've got energy prices coming through. They're really starting to kick through. We may have a cold winter in Europe, and that'll be an issue. And then you've got the labour market, and the labour market in the US. There's a couple of things that I think are interesting there. It took us 10 years to get to less than one worker per unemployed person. Less than one job opening per unemployed person. So to get to 0.8, it took us 10 years from 2008, and we're already there in the last year since the COVID crisis started. So we already have this labour shortage coming through. And I think that's about the ease of movement of labour and maybe even some retiring labour with this COVID event. So there's a lot of things sort of happening there. Like we're watching a lot of companies. We're seeing a lot of margin pressure. But generally speaking, the conversation that we're hearing is that there's still aggregate demand out there. And
demand for what?
Demand for everything. Like there's demand, maybe you'll see aggregate demand for computers come down as we get out of this lockdown. but there's aggregate demand for cars, there's aggregate demand for other things, but the supply is not there. And so we've seen inventories run down. Inventory cycle is usually a positive thing in a business cycle. And then you have this inflation pulse. Now, but this is all happening on the back of having record low interest rates. And so what's happened in this last quarter is we've seen the interest rates start to rise again globally. And one of the things that we're seeing, and probably the thing that we find quite curious, is the more vaccinated you are, the more activity you're going to have. And I think Australia, we've just put some shorts on Australian interest rates because it looks like before the end of the year we'll have 90% of the population, or at least in, I think, Victoria and New South Wales, will be vaccinated.
Yeah.
I think we'll have a very open economy. It will be starkly different than what we have right now.
And so what does that mean for interest rates?
I think activity can be a lot higher than people expect. I think there's a lot of stored consumption because people haven't been able to consume.
100%.
And I think there's going to be a lot of activity. And what people are worried about is whether we will have stagflation, where usually you have inflation and low growth. I think we could have inflation and high growth. It's possible. But again, the risk of stagflation is what people are starting to price in. And one of the reasons they're pricing it in is obviously some of the activity in China has been less positive than elsewhere in the world. To be honest, Europe looks pretty interesting right now, looks pretty positive. The US, to be honest, having started out of the blocks very well on vaccinations, they're not as good. So they might have a little bit more activity problems, but I think they'll probably legislate people have to be vaccinated in certain areas.
Can I just, Richard, just go back to the comment you made about employment and 0.8 of job openings? The wage inflation, how sustainable is that? Because I know in the US they're raising minimum wages for minimum wages are rising globally, but also
have been for a few years.
Yeah, and also domestically. Like how sustainable is that if we do have such a tight labour market?
I actually think this time it's different, and because it's so quick. Like I think the last cycle, don't look at this as a normal recessionary cycle. Like out of 2008 it was like a 12-year cycle. Literally, we've gone from being having a lot of unemployment to having a lot less unemployment, and I think we'll see the same in Australia. So I think labour can get a lot tighter, a lot quicker, but it's partly to do with the ageing of the workforce. It's there's all sorts of things, but this is not the same. Don't think of this cycle like 2008 because it ain't. It's just a very different cycle. In the credit space that we are predominantly in, we're seeing good earnings growth, but if the growth is not as good, it doesn't really hurt us. Like credit-wise, that works. But we have seen some blow-ups, and there's stuff happening in China. China's concerned about the cost of living, and that's part of the reason they put some pressure on the property development side, and which is one of the big topics of. Can we
talk about that? Because that was last week or the week before, that was the Lehman Brothers equivalent. The whole financial system was going to collapse, and everything was we were going to relive events of 2008, 2009.
Yeah.
That lasted all of 2 days, and here we are again, and it's that newspaper's in the bin now. Like what's your take on that? Can you shed a bit more light on that?
Yeah,
and I might be a bit flippant, so
I don't think you. Sorry, I think you are a little bit flippant. It's always a risk. The conversation is around a lot of the property developers in China, and Evergrande, the one that everyone's talking about. We sent an update. Sorry, that would be my dog. Thank you, Buster.
There was not supposed to be a second guest here.
I know. I may have to grab him. So the issue that is transpiring in China is we have lots of construction and development companies, and they're very large construction and development companies. The one in particular that's an issue is Evergrande, and Evergrande is it's like a very speculative company that's building a lot of high-rise apartments. Like literally, they've got more than 1,300 projects in 280 cities in China. They've borrowed a lot of money. And basically, the Chinese government is trying to get speculation out of housing because they're worried about the cost of housing is limiting their growth. So it's limiting their growth because the cost of housing is going up. And then for people to have children, it's very difficult. So the one-child policy has gone by the wayside, but they're still not producing kids. And one is because of the cost of living. Now, Evergrande is a high-yield property development company. We're talking billions and billions and billions of dollars. It actually makes up about 1.5% of the global high-yield index.
Right.
And because of that, it is a huge company, but it's not necessarily a systemically important company.
And maybe explain why. Why is it not systemically not that important?
Well, systemically not important because if I was to put it into context, it's not a bank. It's not levered to a bank. Now, could it bring down a bank? It does have equity in a bank, and that bank has had some problems. Is that a Chinese bank? It is a Chinese bank. We looked at the actual company many years ago. We looked at it, and we could never get comfortable with it. And one of the reasons we couldn't get comfortable with it is as a company, when you were an overseas lender to that company, you were structurally subordinated to the onshore lender. Mm-hmm. And from our point of view, we never actively put ourselves in a position where we're subordinated to a holding company or another type of investor. But it was a very attractive credit spread. The credit spreads on these things were very large. China put in place a thing to crack down on excessive lending. It was called a three red lines policy. And this property development company failed on those measures. And so they were getting close to refinancing, to paying a coupon on their bond and refinancing a bond. And they're obviously having trouble. It's not just them. There's another company that's also having trouble.
I saw that, yeah.
And we saw the debt fall from the 80s in June, the beginning of June, to $24, and I think it's around $20 today. So and historically, what's happened when these things have defaulted in China, the government usually comes in and helps the company out. Now, it seems to us that it's less likely they'll do that here. They don't. Kaisai was an example of a company, a property market company in a similar environment, but that's when the Chinese government was being supportive to property. And so, it's a problematic issue. It's problematic because, one, it's a large supplier. It owes a lot of money to suppliers. It owes apartments that are not finished. I think what happens and normally happens in China is the Chinese government tries to protect the retail investor, and then the wholesale investors just shit out of luck. We're not an investor. We don't have any direct holdings or indirect holdings, and we sort of sent out an email on that midway during the month. But some people were saying, well, this could be the Lehman moment, property markets fall over in China. And it's possible too, because China has managed to reinflate its economy by borrowing a lot. Now, it's still possible it could happen. It still could be a contagion event, but it's not like a bank that has cross holdings with other banks. Now,
which clogs up the system.
Correct. And it stops it becomes a systemic risk to the overall system. Now, people owe money to this. There's a couple of, I think it's the banks that owe money. I think it's BNP, Royal Bank of Canada, and then there's two large funds that are owed money. One is Ashmore, and the other is BlackRock. So they're owed, and they're it's like 400 million circa. It's pretty sizable. But BlackRock's the largest index manager in the world. It doesn't surprise me they've got a bit of exposure. And Ashmore is a large emerging market debt player. Now, we've looked at this. We didn't like the structure of it. There have been some investment banks that have been promoting the whole idea of Chinese high yield. I don't think it has contagion. There are questions, and of the questions, how will it impact other developers? Well, it looks like one is close to going into default. How will it impact the consumer confidence in China, and property prices? How will the Chinese government react? When will they react? And the Chinese government has been tightening its monetary policy and slowing things down. Now they're actually loosening things up. I think they're loosening it up so there's a bit of wherewithal to be able to absorb these defaults. And they don't have a normal market system like we have in the West, where you go through a Chapter 11 process.
Yeah, that's the thing that I'm really curious about, because if there are a whole bunch of people that have bought apartments off the plan or bought these properties, I mean, presumably it's not a very good look or not supportive of the Chinese government to let the company fail, then do nothing about it. I just don't see how that works for the benefit of the people.
Yeah, socializing the losses of a highly speculative property development company, I'm not sure whether that's ever in the interest of the public either. I think what will happen is they will manage it so the properties get finished. The retail investor gets protected more so than they would, say, in the Western world. They haven't got a good process for putting companies through default. It looks very similar to our system, but it's just not functioning that way. But again, I think overseas investors will actually get hurt. And currently, where the debt's trading is an example of how they're being hurt. The recovery rate's going to be very low, and it's one of those things where I think that recovery rate was always going to be low. And when we were looking at that sort of debt, there's a recovery rate of zero. Now, it's a highly speculative company. It was rated CCC. It's been priced for having problems for a while. So I don't really think it's a big, huge event, but it's a large default.
I just wonder how much you talk about confidence. You talk about investors investing in China and Chinese credit and whatnot. And the comment I made before about everyone or the media really writing about this being the next Lehman moment. And I say that flippantly, but also to some extent, people forget about the risks that are inherently embedded in these things. And so nothing happens for such a long period of time. People want part of the growth story. The growth doesn't necessarily mean returns, by the way. People want to participate in that, but then when it all hits the fan, I mean, there's been nothing to really write about other than COVID and maybe some US elections a year or so ago. And I mean, really not much else for the last 15 years, quite frankly. And so I think that whole ride that investors have been able to enjoy has been relatively smooth. Do you agree with that?
I think it has. I think probably the biggest tailwind that most investors have had has been the tailwind from constantly lowering interest rates, and it's allowed for more leverage in the system. and it's allowed for people to get a huge tailwind to their investment. And I think people are mistaking the good luck of lower interest rates from good management. And I think that's actually something we're going to see over the next period. Like, I think it's highly unlikely that we won't see higher interest rates from here.
So you've got money flowing into the funds that you're managing, Richard. You've got presumably, the way I see it is there's lots of money slushing around and very limited investment opportunities. And so naturally what that does, you talk about leverage, or you might swap that with taking on more risk and investing in things that you wouldn't necessarily invest in. How do you, as a money manager, contain or manage risk whilst making sure that you are generating returns that investors are happy with, but also that you don't blow out your risk management?
Yeah, and that's part of it is getting your systems in place to manage risk well and being consistent at managing risk. And it's where your investment discipline comes in. And to be honest, I think a lot of people don't spend enough time looking at the systems that people run, and also don't look at how people run their investment discipline. Like, how do they look at different exposures? And again, like, we've seen some assets, like we still see some cheap assets out there. We still see airport debt, airline debt. It's very cheap, and it's going to be repriced soon around basically the economy opening up. But there's other debt that looks,
but doesn't the market already know that, Richard? Doesn't the market?
No, the market does know that, but it hasn't fully priced it yet. It will. Once the economy is fully opened, it will fully price it. We think that's happening, so we're happy to hold it and see it fully priced, and then we'll rotate into some other debt. But when you see some debt get more expensive, we'll also leave a margin for error in our portfolios, where we're, like, some portfolios we are obligated to run the risk as much to the index as we have to. Like in loans and high yield, we run a risky portfolio to a risky index. In other portfolios, like our global income fund and global opportunities fund, we dial our risk up and down.
As you deem fit? Yeah.
As we deem fit. It's a team approach, and we do reviews, monthly and quarterly reviews, but we're looking at what the potential return is for the risk that we're taking. And then we align and we try and rotate into different securities that give us the best relative value.
Can we just talk about, you talked about inflation before. Why is that so bad? I mean, everyone's talking about this whole concept of whether it's transitory or not. Hey?
Inflation in itself is not bad unless it's too much inflation.
Yeah, but if you've got inflation sitting at 4.5%, 5.5%, I mean, presumably that's not that good. What impact does that have for credit markets and those that are investing in credit?
For all people, right? The real issue with inflation is it erodes the purchasing power of your currency, right? So if you've got $100 invested and you want to, like we've got so used to making money above inflation, I don't think we've sort of worked out, what happens when we make less than that. It erodes our purchasing power. And again, if you see 5% inflation and we're not making that return through our investments, then basically the capital that someone saved for their retirement is eroding. And that's why it's an issue. And it's a serious issue. Some companies can protect themselves from that. And I think where you have good aggregate demand and growth, you can pass on that increase in cost to your consumer.
And that's what you're talking about now. That's what's happening right now. The demand is there.
I think that's what's happening right now. But if it gets to the stage where the demand is not there and we have the prices increasing, and you can't, input prices increasing and you can't pass it on to purchasers, then you've got a position where your margins are being eroded, and
but that's the $64 million question. We don't know whether or not that's going to be sustained or not. You look at food prices.
I think the first thing we had was earlier this year we said inflation's transitory. It's turning out it's less transitory than people thought.
Yeah.
I've never been one to argue that we're going for hyperinflation or anything like that. But if you have an inflation rate that's twice your historical inflation rate, now that's an issue. That's an issue. Like, it's going to be an issue for a while if you have that. And I think we're more likely to have a slightly elevated inflation rate for a while. And usually we used to be able to put our money into cash that would protect its real value. We can't right now because we're being encouraged to speculate. And at some stage, I think, when you have inflation and full employment, which I think we're going to have, that's basically makes it likely that central banks will increase interest rates. Now, the market may not like that. And again, it should be that the central bank doesn't really care about the market. But we know they do have some sensitivity to it if it affects employment and inflation. But it looks like those two things are sorted. And we were worried about having deflation previously.
That's right.
Now, but that was in that 12-year cycle post-2008. We did not have a recession, even though I know people are going to hate me for saying we didn't really have a recession last year. We just had half the businesses were closed by government restricting activity. The other half made a lot of money.
Yeah.
And some of them even got paid, even though they were making a lot of money.
Sure.
Which is a bit of a problem. I think this is something the Labor Party will probably make a lot of mileage out of. So this is not, we're not recovering from a recession here. We're turning the lights back on and we're back to where we were. We were getting close to having a shortage of labour. We've got a shortage of labour. We've got slightly higher inflation. We've got slightly higher inflation. Now, will it persist for a long, long time? Like, we think the base effects will decrease, and maybe in March to June next year, you'll have a higher base for the inflation number. And that'll make it more difficult to get a higher inflation number. But at that stage, we may actually get more inflation through the secondary effects of pricing. So again, it's a complex situation right now. And again, I think sort of talking about it is helpful to sort of digest how it's actually functioning.
And then for investors investing in fixed income securities or credit or whatever they're investing in that sort of gets lumped up in the fixed income bucket, what does all of this mean for them? Because they're depending on the duration of some of these investments. Some of them, not much would have happened. Some of them would have taken a haircut.
The duration's the issue, right? So
that's what you think the issue is. It's what your duration is.
And everyone says, duration's an issue for fixed interest. Now, let me be very clear. Duration is an issue for all assets that have a cash flow because that's a basis of the valuation for them. So if you've got a very long duration asset, that is a big issue for it. So infrastructure is an example, property.
We saw this with technology when we spoke not that long ago, right?
Yeah, exactly right.
But I think with fixed income, it's so much easier for someone to see, that's a 10-year bond, it's a 10-year duration. Yeah, whereas you look at a stock and I don't think people talk about duration as it relates to stocks.
No, they don't. They should. It's actually poor maths not to, right? And
100%.
All duration is like it's a shorthand way of calculating a net present value for a change in interest rates. That's all it is. It's not. There's no. People like to say it's more complicated than it is. And literally, you've got a lot of companies that have annuity streams that are cash flows that go out a long way. Apple would be an example. It's got an annuity stream. It takes it out of your bank account every month, I think. Would that be right, Rob?
I don't know. I'm Android.
It's probably more. You're less profitable for them than the Apple client. I'm an Apple client, and so I'm making them lots of money. But again, I think this is an issue, and like most of our funds are a floating rate right now. They don't have any interest rate duration, except for our high yield fund, because it decreases the risk in that fund. And then in some of them we've bought options on interest rates going up, and that's in the last month. Like I note you said there was lots of asset classes that returned negative returns. Well, we delivered a positive return in the quarter, partly because we had some interest rate options that paid off, and we also have some floating rate debt that people want to buy. So it's rallied when other stuff's been selling off, and I think that's actually the thing that as a portfolio manager, I have to anticipate what people will want to buy in a year's time, and that's part of it. And it's probably in a year's time, I don't think they're going to be wanting to buy airport debt.
Why?
Because I think it'll be fully priced. Well, I'll definitely be selling it in that period, because I would have made my money, and there'll be no incremental margin above the average margin.
I guess with the benefit of hindsight, wouldn't it have been better to buy airport debt 12 or 18 months ago?
And we did. We did, and we're still holding it because it's trading above its well above its average levels. So we still think it's good value. Well, it's good relative value. Relative.
I understand. I understand.
But again, we did, and we lent money to Qantas at 4.5% above the cash rate for 10 years, and it's now trading 200 and something above, which means we've made a
absolutely.
Yeah.
And so what do investors need to think about beyond duration, Richard, when they're looking at, and maybe most investors don't think about this, advisors, I suspect, CIOs would be thinking about these things about duration, but for the everyday punter, what are some of the other things they need to be thinking about if interest rates are at the risk of rising? But we've been saying that for 15 years.
Firstly, you probably start with your housing debt. If you've got housing debt, you should have. My thing would never be 100% fixed or 100% floating, but I think you should have at least 50% fixed right now, at least. And then when it comes to your portfolio construction, if you have a good advisor, they should be able to tell you what the effective duration is that you're running. If you're running a very long interest rate sensitive portfolio, you will always have some of that, but should you have as much as you do currently? And again, like interest rates rising reprices assets.
Yes.
Like the average return that we've received in the last few years is higher than the historical return. It actually probably leans towards the market giving lower returns going forward. So if you see interest rates go up by 2%, what assets are going to give you a positive return? Like I think some of our floating rate assets in the fixed interest space will give you a positive return when other assets won't. And that's the thing. And it's always historically we had this thing where everyone will say, the last 20 years bonds have been negatively correlated with equities, and it's been this risk parity trade where you hold bonds and they balance your portfolio. Well, the 20 years before that and the 20 years before that, interest rates and equities were positively correlated. It means when interest rates sold off, the equities sold off as well. And I think we're likely to be going back into that environment. And if that's the case, then got to be careful how your portfolio is constructed.
Yeah, that is interesting. I think it was the Wall Street Journal that put an article or did a piece of analysis that showed back in 1995, for example, the composition of one's portfolio was like stocks and bonds, and that portfolio gave you like 7.5% on a 12% per annum annual standard deviation, and then it kind of worked backwards and said, well, what do you need now in order to achieve that same rate of return and same volatility? The composition of that portfolio is literally a mixed bag of lollies: stocks, bonds, venture capital, private debt, a whole bunch of things that weren't even considered asset classes 25, 30 years ago.
And we know that when interest rates get really low, people's risk appetite goes up to make the same return they have historically.
Correct.
So I think it's a problem. If you go back to when superannuation started in Australia, you would have got a 4% real return just investing in bonds. So that means you were getting something like 6 to 8% per annum just out of bonds.
Yeah, but what were you getting in your stocks?
To be honest, you didn't actually get that much better in stocks. Like stocks actually underperformed for a lot of the period. They underperformed. They've recently caught up a bit. I think we've got the numbers. We'll share them with you. It's like since the inception of superannuation, we run quite a lot of numbers. The reality is it's relative to the risk that you're taking. What return are you getting?
Sure.
And that's the thing that's really hard right now. And to make it used to be that we'd have a target of 4% real return. 4% real return where cash rates are right now is really difficult.
Yeah.
It's one of those things that's like
with a 5% inflation rate.
A 5% inflation rate and interest rates at 0.25%. I think that's really difficult.
Yeah. Why did you say before when interest rates go down to zero, people start taking on risk, and we sort of just moved on from there about the different portfolio composition today compared to 20, 25 years ago? Is that an issue, Richard, or is that an evolution of the market and market participants' savviness and what's available for investors to invest in? Surely times have changed. I think they have.
Okay. Again, it's a point in time. We won't know until we see
100%
play out, whether that's the case or not. Generally speaking, I've been through a number of cycles. I see lots of similarities with the end of a cycle emerging here, but it's still. I think it's still probably got a year or two to go. But and the reason I see that is when you have very cheap borrowing, the temptation is to go out and buy what you can afford to pay the interest cost on, and never more so than in property. If you look at people's houses, people can afford to pay more for a house. A lot of people say, "Oh, it's irrational where property prices are." No, it's rational where property prices are where they are because the interest rates are where they are. Someone can afford to service the cost on buying a house at this current price. Now, recently there's some macro-prudential limits that have actually said, well, why don't you price in before you lend to someone whether they can handle a 3% increase in interest rates? Now, I think that's eminently reasonable, but there are some people that just wouldn't be able to tolerate a 3% increase in interest rates and stay in their house. If their income's not changing accordingly. So again, and then also I see a lot of private debt transactions and liquidity people taking on. And illiquidity is sort of like one of those things that you don't worry about until you need it. And when you need it, funnily enough,
everyone else wants it too.
And it's ephemeral too, right? So in something that's illiquid right now might be, you might be able to buy and sell it, but in a period of stress, you probably won't be able to. And there'll be a discount for selling it at that time. Again, I don't think last year was a recessionary environment. I think people saw it come through and they go, look, we just went through a recession. No, you did not. It was not, default rates got to like 5% in the US. Historically, in a recessionary environment, it's 10 to 11, 12%.
Just on, you talk about leverage, and I hear, and I don't disagree with you at all, but isn't there an element here that's beyond just leverage? There's just cash, like people have got so much money. The weight of money. That's right. And so they're not taking on risk by leverage, although I'm sure there are some parts of the market that there are. You look at bank finance and bank or household debt, it's crazy. It's insanely high. the interest rate that people are paying now is equivalent to that of the interest rate that they were paying in the early 1980s. So to your point, serviceability is a lot stronger than what it was 5 or 10 years ago. But putting that debt to the side, there is a ton of money out there just literally, in the wilderness, just hunting for yield, hunting for...
Yeah, there is. And like I've heard people say, anything but cash, just because the carry cost of holding cash means, you're losing 2 to 3% of the value of your money. It makes a bit of sense. Listen, though, this too will pass is probably what I would say. We're going into a stage where the US Federal Reserve is going to start tapering, which means they're going to stop buying bonds.
Yeah, but they're not doing that tomorrow morning. Like that's.
I reckon they'll be doing it this month or next month.
No, I mean they're not turning the entire tap off, right? It's a gradual process.
They're going to stop. They're going to stop buying as many bonds.
That's right.
And it's the taper, which means they start buying less and less and less. But they're stopping to buy. So literally, the supply and demand for bonds is going to change. So interest rates can go up. We also know that inflation's spiking right now. Now, they hope that it's transitionary, but we're seeing knock-on effects of this. And we're also seeing, 4% wage inflation. We're starting to see that creep back in. Again, my thing is, we don't know for sure what will happen in the future on this, but the risks are now leaning towards higher interest rates. And how does that impact? Leverage stuff is going to have problems. If you've got term leverage, maybe you make more money. But it's going to be an environment that's going to be a transitionary time. I think GMO came out with some stuff. They're a traditional value manager in the States, and they said, we can go into hell or we can go into purgatory. And purgatory is where interest rates go up and assets get revalued and we can construct normal portfolios. Hell is where either they don't change and we're in this situation where we have inflated asset prices, and those inflated asset prices could become a problem. Interestingly, I think what the Chinese government is doing is partly around inflated prices. And generally, central banks have been loath.
You mean managing inflated prices?
They're worried about inflated prices. Right. I think these inflated housing prices do eventually come through in inflation. And they do eventually sort of catch up with us. Again, I don't think the CPI is actually reflecting the true cost of living, which I think it will eventually. Like, it comes with a lag. Because there's an imputed rent that comes through. On the credit side, to be honest, low interest rates make interest serviceability easy, which means you're not going to get defaults until interest rates get high. A lot of companies have termed out their debt. They're not dumb. They don't run hot books like they used to before 2008, because 2008 taught them that they should be very careful on funding things. So there will be but there will be companies that won't be able to. But these Chinese property development companies are going to have trouble refinancing. If they can refinance, they survive. If they can't, they don't. And that's the sort of thing that we're going to see.
Is all of this bad for credit?
No, not at all. It's like I would see. I'd see some of these things being quite good for floating rate credit. Floating rate credit, as you see the interest rate go up, it increases the yield on the asset, but it doesn't give you a penalty for any loss. So you actually just get a higher yielding asset. Generally speaking,
but presumably the net return would be, let's say, similar to what you were getting before. You're just getting this adjustment for inflation and interest rates, no?
Yeah, you're getting the adjustment. You're not getting a capital loss for it.
Sure.
Whereas in say, if you're in a 10-year duration bond fund, a 2% increase in that is a 20% loss in that fund. Obviously taking that out is a great way to get a return. a positive return when other assets are negative. And I think it's likely, we'll have a period where we've got, and I hate to say it, Rob, as long as I do, there'll be periods where we're going to have negative returns. It may well be that we have more negative returns because you may get a negative return on bonds at the same time as you get a negative return on equities. Now, it's been a while since we've had that. I just think that's one of the things we're just going to have to contend with. Now, does it mean we're going into a more normal economy? Well, maybe. I think a little bit of inflation is good. Too much inflation is not so good. And also, all the central banks, including the Federal Reserve, have actually now allowed, they're not being dogmatic about that level of inflation. They're saying, we'll let it run above that level of inflation, but that increases the risk that they have to react. And that's what I think people are starting to price. And I think we did a webinar, and if anyone wants to look at our website, they can look at our webinars historically. We did one on when doves cry earlier this year, because a lot of the doves have changed their view. Like Summers and Yellen and some other people basically saying, no, we've got to be careful here. We're starting to see inflation come through. We're a lot closer to full employment than we have been in previous recessions, because it's not really a recession. I think this is the mini recession, half a recession, if you really want to say it, but it turns back on a lot quicker.
And I talk about just on you talk about those central banks and that, and whether it's the Federal Reserve or whoever it is. You gave an example before about if the US Federal Reserve starts to taper their bond purchases and they're buying less and less bonds, which there's no more we don't have that demand for bonds. You've got interest rates going up. That then has a flow-on effect to a whole bunch of other things. What role does the central bank then have to play if, under that scenario, you've got yields going up, you've got adjustments in risky assets? So for stocks, for example, is bad for stocks. Stocks start falling. You've got capital losses in bonds that are long dated bonds. What role does the central bank then have to play in all of that? Are they then rising? Are they raising rates?
Yes, they're raising rates. They raise rates. So if you've got full employment and you're starting to get wage inflation,
that's the big one, right? The wage inflation.
Well, no, it's inflation generally, but wage inflation comes because the earning power of someone's salary is being eroded. And now, the unions are not as strong as they used to be, but I tell you that the different generation is not feeling very amorous towards their older generation when they can't buy a house because it's too expensive. They don't have the assets to buy that house. The inflation rate's going too high for them. I don't blame them for wanting to have a higher wage to compete for that. So I do think that's what we're going to get. But the tenets for raising interest rates are, do we have stable prices and do we have full employment? Now, it looks to me as though we're going to have full employment sooner than expected. And we have less than stable prices. So I think we're going to see some inflation in prices. Now, when you have full employment, if inflation is doing nothing, well, the central bank doesn't need to do anything. But if you've got full employment and rising inflation, and you've got interest rates sitting below the inflation number, giddy up, central bank, you should be increasing interest rates. Now, it's nothing wrong with that, because remember, we'll go through a stage where interest rates will increase. And hopefully we get that done before the next cycle, because if we don't, it's pretty icky, right? I would like to see them increase interest rates by at least 2% so they can decrease them by 2% next time. To be honest, I'd probably prefer to see them go up 3%.
Over what period of time, Richard?
Well, it could be over 3 years, 4 years,
Yeah, I mean, so you're talking about 4 or 5 years with 25 basis point rises. Like,
but Rob, but the market will start to anticipate it as soon as the first rate increase comes
Of
in.
course.
And they've already started. New Zealand increased interest rates last week. Some other countries have increased interest rates. Looks like the UK is going to increase next month. And then you've got Canada increasing. Listen, what is not up for discussion is whether interest rates need to go up from here. They do. How much they go up and how quickly they go up, that's the discussion. But more recently, we've had this inflation pulse come through, which is concerning. And that's why people are worried about this stagflation risk. And stagflation is really risky because, if you get low growth and high inflation, well, what that basically means is you can't pass on. You can't pass on the margin. So it means companies will look like they're overvalued. But companies may well be overvalued on current interest rates. And so that's where, and again, maybe I'm always the glum guy, but I don't mean to be the glum guy. It's just, if I look over time, it looks to me like there'll be a period in the next 3 years where returns won't be as good. And I think preparing clients for that's a really useful thing to do. That way, there's no surprise, and it may be a transitory environment.
Sure. I guess the saying does go, be careful what you wish for. We've been wishing for this situation for years and years and years.
We've been wishing for inflation, and now we've got it.
You got it. Now what are you going to do with it?
Yeah, that's right. And again, I've got some stuff happening in my house right now. I've pre-bought furniture. I've pre-bought everything because I don't
buy your toilet paper as well, and timber and.
Don't blame that toilet paper shortage on me. Two teenage boys, they do use a lot of toilet paper. No, it's not me.
Can we maybe just touch on, just finally before we wrap up, Richard, can we just move domestically and talk about the Australian market, interest rates? We Aussies love interest rates, love our debt, love our housing, and what all of this means for us more close to home.
Yeah, we're I'm in Sydney, so we've just been unlocked. We've just.
When was your Freedom Day? Was that yesterday?
I hate the word Freedom Day.
I know.
I hate it. Yeah, it was. I went out and had a cocktail yesterday. It was
nice.
Thank you very much.
You should have got your hair cut too, mate.
Yeah, I've got to brushing it back. It's
it looks good.
A mullet at the back, unfortunately. But yeah, I think we're escaping from lockdown now, and activity will go up a lot. And I also think, the vaccination rate in Australia, we're a country that does vaccination. I think we're good at doing vaccination, and I think we'll have 90% coverage. Definitely in the, Victoria, New South Wales.
Yeah.
The other states may take a little bit longer because they haven't had the same risk. But, I think it will be that state where, you show the tick. You've got to show your little wallet of that you've double vaxxed to do things. I think until we get to 90%, that's what you can look forward to. Once you get to 90%, I think we may decrease the amount of problems that we have, and then I think travel is going to open up quite a bit. And I'm looking forward to some travel. I'm sure your clients are as well. And then that cash flow will come through. I'll be able to sell my Qantas debt at a much more expensive level than I bought it at, and life will be a bit better. But interest rates in Australia, well, listen, you're right. There is a level of indebtedness in Australia. I do think people mismeasure it sometimes because I think Australians hold a lot of assets for their debt.
You talk more like a debt to equity ratio.
Yeah, I think you've got to. You can't just look at the debt but standalone. You got to look at the assets as well. It may limit the ability of the central bank to raise interest rates. I know the central bank's concerned about it, and they'll be measured in increasing interest rates. But to be clear, they don't set interest rates globally, and globally interest rates are going to start to rise, I think, before they rise in Australia. But Australia opening the way it will, because we're getting vaccinated really quickly, I think Australia will be very open by Christmas. We may still have COVID in the area. We may still have people worried about the level of hospitalisation, but we'll be open. There will be international travel early next year, if not December, November this year. And I think that'll lead to a lot more activity. If unemployment goes below 4%, expect interest rates to go up. We will have inflation already by then. And that means they'll be behind the curve. So they'll have to do a bit.
Yep.
Now, maybe they do 1%. I would not budget for 1%. I'd budget for 1 to 2%. And then on the outside, that things get a little bit too, I don't know, I'm dealing with a few people around things like all I'm hearing is the cost of construction, the cost of everything is just going ballistic. So maybe 2% is the optimal level, but it could be higher. And
then what that means for prices, Richard, then, if we think about...
Well, eventually you'll see it probably means housing prices start to rotate on the way down. Maybe they do nothing. Maybe they go down. I know no one likes to hear housing prices go down in Australia. I own a house too, but you're consuming a house. It's not the biggest investment as every Australian expects it to be. But yeah, and it'll reprice things. It's probably good for banks because banks run an asset liability book. It's very hard to give you less than zero on your deposit, but when interest rates get to 2%, they'll be quite happy to give you 1%. And they make money on the liabilities and the assets of the bank. So,
and I just wonder also what impact that has on investor psychology and what investors are then prepared to do. If I get zero in the bank now, if I get 1.5% in a bank deposit, you know what? I'm going to take that risk off the table now.
Yeah, and if it's closer to inflation, I'm going to hold a bit more cash. But now I think people are holding cash because it's an option to reinvest.
Agreed.
And that's why people hold cash. And there's no substitute. Like cash, you can deploy straight away. I know there's a lot of people that like, I want something that's like cash, but I want it to pay me 10%. Well,
while it's
you know what? I do too. I want that too. It doesn't exist. And if someone tells you it exists, maybe you shouldn't trust them.
Yeah. It appears as though we're turning a corner. We're turning it really slowly. No one really knows what's on the other side. But as time goes on, and as we as investors have more information, we can make better decisions about money and investments and decisions. But I think the bottom line is people need to look at these things as it relates to their own circumstances personally, rather than what Richard's doing, storing or buying tradies in earlier on and booking them in. It doesn't matter what you're doing. The decisions I make for me should be for me and looked at through that lens.
I think you've got to be very careful though, having short investment horizons. If you've got a short investment horizon, 1 to 2 years, cash is your alternative. There's no real, because you can't, during that period, you can't ride out any volatility at all. And that's an issue. So, I think that's the way to sort of think of it.
Yeah. Richard, might wrap it up. Good to see you. Good to chat to you. Thanks again for joining me today.
No worries, Rob, and go the Bulls. And I'll just because we're in the throes of ending all this, I have to lend. We're doing a thing, the Great Escape theme, escaping.
I saw that. What's that about? What's the Great Escape about?
Well, the Great Escape was a book written by an Australian journalist that was also a Spitfire pilot who was in the camp. The Great Escape's a movie and it stars some famous actors, but there's a theme that goes like this.
I do remember it now. I do actually.
It's a great movie, and it's the theme for our webinar this quarter. That's Great Escape from lockdown.
Oh, from lockdown, not escaping from low interest rates.
No, I think we'll do a dam buster thing on the interest rates, and it'll be, and we'll have the little stick where you've got and inflation. Drop them. Surprise, we'll do everything. But anyway,
Thanks,
best of
mate.
luck to you and your investors, mate.
Thanks, Richard.